Warren Buffett is about to make his biggest move in 17 years. $382 billion. That's how much dry powder Warren Buffett has sitting in Treasury bills right now. The last 3 times he built a cash position this large, what followed wasn't a crash. It was a buying spree. 2008, 2011, 2020. Over $50 billion deployed during market dislocations at terms that generated tens of billions in profit. And now, he's sitting on more cash than all 3 of those periods combined. While everyone's asking why is Buffett selling, the more interesting question is, what is he preparing to buy? This isn't defensive positioning. It's a loaded spring. The pattern. Financial media reports what Buffett does. They rarely report what it means. Buffett sells Apple. Buffett dumps Bank of America. Record cash position. But they miss the pattern. And the pattern is everything. Warren Buffett doesn't hoard cash because he's scared. He hoards cash because he's hunting. There's a difference. Fear is reactive. Hunting is strategic. Every single time Buffett has built a war chest above 20% of assets, what followed within 12 to 36 months was a systematic deployment at valuations that made him tens of billions in profit. This isn't about predicting a crash. It's about positioning for dislocations. And dislocations create opportunities. The kind that happen maybe twice, 3 times in an investing lifetime. $382 billion in cash doesn't signal getting out. It signals getting ready. What follows is the framework Buffett has used 3 times before to turn market chaos into generational wealth. And right now, every indicator is flashing green for deployment. Layer 1. The deployment calculator. At current valuations, Buffett's $382 billion could theoretically acquire 100% of Costco at $275 billion market cap, or 100% of Netflix at $330 billion, or controlling stakes in 8 of the top 20 S&P 500 companies. But here's what makes this different from 2008 or 2011. Back then, Buffett had $30 minus $40 billion to deploy. Today he has 10 times that amount. The scale of what he can do in a dislocation is unprecedented in corporate history. And he's not just sitting on it. He's earning 4.3% risk-free on Treasury bills. That's $16.4 billion a year in interest income. For context, that's more than the annual revenue of companies like Airbnb or DoorDash. He's generating unicorn-level profits doing absolutely nothing. But those Treasury bills are short-term, 90 days, 180 days maximum. He can convert to cash and deploy within a quarter. This isn't money locked up. This is money staged. Berkshire has spent the last 3 years restructuring the portfolio specifically to maximize deployment flexibility. Layer 2, the portfolio concentration strategy. The Apple sale isn't about being bearish on Apple. It's about liquidity concentration. In 2023, Apple was 50% of Berkshire's equity portfolio. That creates a flexibility problem. $175 billion tied up in one position limits deployment speed. You can't pivot quickly. So Buffett systematically reduced Apple from 50% down to 21% of the portfolio. He converted $110 billion of Apple stock into $110 billion of liquid cash. Same with Bank of America. He's not exiting positions. He's freeing up capital. The portfolio now. Apple, 21%. American Express, approximately 13%. Coca-Cola, approximately 8%. Chevron, approximately 6%. Occidental Petroleum, approximately 6%. This is a diversified, flexible portfolio. No single position dominates. When opportunity hits, there's no need to sell winners to raise cash. The cash is already raised. And Berkshire hasn't made a major acquisition since 2016, when they bought Precision Castparts for $37 billion. That's almost a decade with no major M&A. The question is, waiting for what? Layer 3, the valuation reset timing. There's a concept in value investing called reversion to the mean. Things that go way up eventually come back down. Things that go way down eventually come back up. Right now, the Buffett Indicator market cap to GDP is at 220%. The historical average is 80%. The median reversion time from peaks above 150% back to 100%, 18 to 36 months. The Shiller CAPE ratio is at 40. Historical average is 17. When the CAPE has been above 30, subsequent 10-year returns averaged 2.1% annually. When it's been below 15, subsequent 10-year returns averaged 14.7%. Buffett isn't trying to time the exact top. He's positioning for the inevitable reversion, and reversions don't happen smoothly. They happen in dislocations. 2008. The CAPE dropped from 27 to 13 in 18 months. Buffett deployed $15.5 billion. 2011. European debt crisis. Valuations compressed 30% in 6 months. Buffett deployed. 2020. COVID panic. Market dropped 34% in 33 days. Buffett deployed $25 billion. He's not predicting when it happens. He's ready when it happens. With valuations at the second highest level in 155 years, the probability of a dislocation is mathematically higher than during periods of moderate valuations. Layer 4. The sector rotation blueprint. Look at what Buffett's been buying, not just selling. The buying reveals where he sees opportunity. Q3 2025. He added to Occidental Petroleum and Chevron. Energy. Q2 2025. He increased positions in several Japanese trading houses. International value. Q1 2025. Small additions to insurance and infrastructure-related holdings. The pattern shows rotation out of mega-cap tech and into energy, historically cheap, massive cash flows, essential infrastructure. International value. Japanese stocks trading below book value. Hard assets. Companies that own physical infrastructure. This is a thesis. Buffett's positioning suggests the next cycle favors real assets, cash-generative businesses, and international diversification over domestic growth stocks. When Buffett shifts positioning like this, it's not about next quarter. It's about the next 5 to 10 years. There's something in the macro picture that makes energy and international value more attractive than U.S. tech at current prices. Layer 5. The succession amplifier. January 1st, 2026. Warren Buffett officially stepped down as CEO. Greg Abel took over. This isn't just a leadership transition. It's a strategic opportunity. Greg Abel is 62 years old. He has a 20-year runway. And Warren Buffett just handed him the largest war chest in corporate history at the exact moment when valuations are extreme. Buffett knows he won't be around for the next full market cycle. So he cleaned up the portfolio, converted to maximum flexibility, built unprecedented dry powder, and handed Abel the keys right as we're potentially entering a valuation reset. This isn't Buffett winding down. This is Buffett setting up his successor for legendary deployment opportunities. It's the ultimate passing of the torch. Abel's first major test will be, can he deploy this cash as effectively as Buffett did in 2008? The pressure is enormous, the opportunity is once in a career, and the capital is unlimited. The synthesis. When you see how all 5 layers fit together, this isn't a warning signal. It's a preparation signal. Layer 1. $382 billion in liquid, deployable capital, earning $16 billion plus in annual interest. Layer 2. Portfolio restructured for maximum flexibility and fast deployment. Layer 3. Positioned before an historically probable valuation reversion. Layer 4. Strategic rotation into sectors positioned for the next cycle. Layer 5. New CEO ready to prove himself with the ultimate war chest. This is not defensive. This is coiled. The framework becomes clear. Build cash when valuations are extreme. Restructure for flexibility before you need it. Position in sectors that benefit from mean reversion. Wait for dislocation, not crash. Deploy systematically, not all at once. Timing the market isn't necessary. Being positioned for opportunity when it appears is what matters. And opportunity always appears when everyone else is panicking. The close. Buffett isn't predicting a crash. He's preparing for opportunity. There's a massive difference. Market crashes are unpredictable. Market dislocations after valuation extremes are historically consistent. Buffett's not guessing. He's following the math. The best time to prepare for opportunity is before you need to. Not during. Not after. Before. Right now, Warren Buffett is demonstrating exactly how to do that. $382 billion in cash. Strategic portfolio restructuring. Sector rotation. Succession planning. This is a masterclass in preparation. The question isn't, is Buffett right? The question is, what happens when he starts deploying this war chest? When Buffett begins deployment, the signals will be worth tracking in real time. The sectors he targets, the terms he negotiates, the timeline he follows. These will provide a roadmap for understanding how sophisticated capital allocators operate during dislocations. This is what separates institutional thinking from retail reactions. Understanding the preparation, not just the execution. End screen. Subscribe for market analysis, related content on portfolio construction and value investing, discussion, historical deployment patterns and their outcomes,